Welcome back, everyone, to Lem's Cryptoverse. So today, what I want to talk about is, as I usually say, something different. What's really important is to always test your assumptions and be careful of what everyone talks about in politics, echo chambers. Be careful of listening to people that already agree with you, especially people that you already like. So I'm going to give you an example right now. Let me just minimize myself. So look at that beautiful sunset. So this is from Raoul Pal. He heads Global Macro Investor, what he calls GMI, and he also started what he calls the Netflix of finance, which is, as you probably know, Real Vision. So Raoul Pal, if you don't know, he's about 55 years old. He was born in I believe in England, but his mom lives in, as he says, his mom lives in Spain. So he lived in Spain for a little while. He also worked in New York at Goldman, and now he's living in Little Cayman. So he had this conference in Spain, so that's why he took this picture. And along with the conference, he came out with this newsletter, and this newsletter is focused on inflation. So here's the deal. Here's my story for today. I really like and respect Raoul Pal, but he's saying inflation is going to come down really fast, and I disagree with him. I actually agreed that the first half of inflation, the first 3/4 of inflation, would go down quickly because of various reasons. One, it was just really high, and what happens is, especially with commodities, you get these supply-demand changes, right? So when prices go up a lot, more supplies come on, and that reduces the price because of supply and demand. And also when prices go higher, people buy less of that product, or they buy substitute products. But all that's in the past. So the second half now of inflation is going to be more difficult in terms of getting rid of inflation. It's almost like the law of large numbers, right? When a company grows to, like Amazon or Alphabet, Google, Apple, when they get past whatever it is, hundreds of billions of dollars, even a few $1 billion, it's tough, obviously, to grow at a very rapid pace, percentage-wise, because the revenue base is already so large. Now we have the inverse problem with inflation for various reasons. I told you one or two reasons. See, inflation was very high, and it's easy to come down. One reason, another new reason is base effects, right? Base effects when you lap, from one year to the next, when you lap that year, inflation seems to come down faster because, like, for example, if inflation rose, I'm just making up a number, if oil rose 100% from March of 2022 to March of 2023, and it then stayed flat, when you lap that year, it's actually going to be flat. The year-over-year inflation is going to be zero. I know it's kind of strange. And then there's also lagged effects. So what I want to focus on now is that he's saying it's going to come down quickly, and now I think those days are over. So I'm going to go over that with you right now. First, let's talk about what he said. So here's Raoul Pal, and I'll just give a few pointers. Number one, the first chart he's showing at GMI is PPI, which is the producer price inflation. He's showing it year over year, and he also talks about the US CPI, the consumer price inflation. And then, as you probably know, there's a million derivations just of PPI and CPI, and then there's other inflation indicators. But for now, we're just going to focus on this one. So he said there was another negative surprise. So he's saying that's a good thing. And then he's saying that CPI should work its way down below 3% in the next 1 to 2 months. Well, I think that's pretty fast. And then he says, above, I should have mentioned this one here, US PPI also came in below consensus expectations, 2.3% versus 2.5. So he's saying that it just keeps coming down quickly and in a steady way, and it's coming down below expectations. And that's all true. So here we go. You can see PPI, and he's saying that PPI has a 1-month lead to CPI, and that makes sense because PPI is raw materials, and the raw materials feed into the finished good materials like CPI. So he's saying the trend is sharply down, and you can see here It went up. It went down during COVID. So it went down during COVID, in the middle of COVID, when the economy basically shut down. Then it skyrocketed because we all know that Powell said there's no inflation. And when it came, it was transitory. And then he said he's not even thinking of raising rates. And we know what happened after that. And Raoul Pal says here's an important bit. It's not just the U.S. that's seeing inflation evaporate. Spain, where he had the conference, he said it's minus 1% in March, and here's Spain. So here's where I start questioning things. I would quantify, let me just minimize this. I would quantify inflation as being somewhat global, but it's also local. So I wouldn't put too much value into this chart. So the next one is China. Now here's a separate issue. I just came from a Crane-sponsored conference, all-day conference on China, and everything was discussed. Geopolitics, inflation, economics, and the thing is, Raoul Pal is saying inflation is coming down. But the thing is, China just reopened. China was one of the last countries in the world to reopen. And we saw what happened in the United States as an analog. It takes time for inflation to come back. So this is not accurate in my opinion, that there's deflation and negative inflation in China. That is not correct in my opinion. And then he talks about Brazil having deflation. And remember, Brazil is one of the biggest trading partners of the BRICS countries, including China. So I wouldn't put too much weight into this either. And then he talks about Norway having deflation. This could be because of crude oil going down in price. And let's see if there's anything else. Let's see if there's anything here. Then he talks about supply chain pressures coming off. Okay, I could see that happening. I could see less supply chain pressures because of COVID ending. The ending of COVID means that supply chain bottlenecks are disappearing. Okay, I can see that. Then he talks about median prices of one-family homes coming down. Well, I'd be careful with this one too, because prices came down because of the 10-year rate going up, which directly ties into the 30-year mortgage rate. And when the 30-year mortgage rate hit 6.5 to 7%, that caused housing prices to come down. However, and there's a big however, the big however is that inventories of homes are very low. So I don't see home prices plunging the way they did in 2009, 2010, post the great financial crisis. So I wouldn't put too much weight on this one. And then we got fertilizer prices. I wouldn't put weight on this because this is just a microcosm of inflation. And remember, prices went up. And this is also affected by geopolitics. Think of what's going on in Ukraine. Remember, Russia is one of the biggest suppliers of uranium and maybe even lithium and all these weird, small, lesser known commodities, including potash and certain types of fertilizers. And remember, fertilizer is also affected because when they say fertilizer, really they're talking about three types, right? You're talking about nitrogen, potash, and phosphate. Remember, nitrogen fertilizer is made from from natural gas. And so natural gas got boosted during the beginning of the Ukraine war. So there's a lot of moving parts here. So I wouldn't count fertilizer as part of a rationale for CPI coming down. So yet again, I disagree with Raoul Pal. And then we've got the Atlanta Fed wage tracker coming down. I wouldn't put too much weight on one specific regional wage tracker. And then, and this talks about yield. So I think that's enough for this. This is mostly on yield, and that's the end. This is mostly on yields anyway. So I want to focus with you. Let's look at that beautiful picture again. This looks a lot like, to me, like northern Italy, like the Lombardy region. Then I looked at it closely, and you know how you know it's not Italy? Because Spain, if you look here in the background, it looks almost like a desert, and Spain is drier than Italy, and that's why you could tell it's Spain and not Italy. Otherwise, they look pretty identical. So let's get back to my story here. So here, this is a cartoon about autonomous. It says, does your car have any idea why my car pulled it over? So why am I mentioning autonomous cars? Because there's a saying in autonomous that we're 99% of the way there to get in towards level 5 autonomous, where cars drive you, and you don't even need a steering wheel. But then they say, even though we're like 99% of the way there, we still have 99% of the way there to go to the last 1% to level 5, meaning there's a lot more work to do to get to that last 1% in autonomous driving. And I see it the same exact way for inflation. Even though I'm actually bullish on long-term inflation, I think that long-term inflation is going to come down to where it was before, believe it or not. I think long-term inflation, including the CPI, could get down to 2%. So if I'm so bullish on inflation coming down, why do I think there's going to be such a difficult time coming down now? Here's why. Longer term, we've got demographics and we've got productivity, including what's called AI, artificial intelligence, and ChatGPT level 4. I mean, by the time we get to level 6, inflation's already going to be coming down. But shorter term, now's the problem. I mentioned this, the law of large numbers and autonomous. It's a lot easier to get inflation to come down from 10% to 5 than from 5 to 2. So I want to give you some examples of what I see in inflation and how I disagree with Raoul Pal. First of all, he mentioned top line inflation, but then you've got something called the core PCE, and this is what Jerome Powell and the Federal Reserve look at. This is the Personal Consumption Expenditure Index. It's like 4.6%, and it hasn't done that much in the last few months. And let's see what it was last month anyway. It was 4.6% on previous versus 4.7, but look at this. The consensus was 4.5, so we're not beating estimates here. So number one, like I said, we're not beating estimates. And number two, it's kind of like bumpy here. We're not really seeing a trend, a downward trend. So let's go to the next one. And this data comes from Trading Economics, by the way. The next one is United States non-farm payrolls. This was up substantially higher than expected. I thought it was going to be higher than expected because the ADP numbers were good, but this was even higher than I expected. I expected we would beat estimates. Let's see what the estimates were. So we did 253. We don't have estimates here, do we? No, here we are, April. 253, the consensus was 180. I was expecting 200 because the ADP number was good. And what did we do? We blew that away, and we grew 253,000 jobs. And here's the problem. If you got jobs, you're not going to get people cutting back. It's that simple. And then you got wages, and I'm going to talk about that right now. United States average hourly earnings year over year, look what happened. They actually went up in April to 4.4% versus 4.3%. So again, you're not getting that steep decline anymore. And to me, I mentioned this in previous podcasts and videos, the thing is that wages are sticky, and sticky wages are what's going to keep inflation high. This is why I said months and months ago that the Federal Reserve they have to, I hate to say it, they have to cause a recession. That's actually their goal. They're not going to tell you. No one wants to hear there's going to be an inflation. Powell doesn't want to be the messenger of bad news, but that is the only way he can get to the second part of inflation going down. It's by cutting down wages. And that means working class people. They're going to see cut in wages because that's where inflation is sticky and wages are sticky. So that's the news there, sorry. And I'm going to give you some information. Now, this is manufacturing, so I'm going to give you some information that's different from what I told you about before. I'm trying to give you different viewpoints. So we talked about wages, we talked about the PCE, we talked about PPI, CPI, wages. I said wages twice, okay. Now we're going to talk about something I've been looking at for years. There's two of these indicators. We got the manufacturing PMI and then the services PMI. So services and PMI has been strong. I'm not even going to show you that one. That's been strong, and that means that inflation, it remains high in the services economy. But in the manufacturing economy, which had been weakening, I'm seeing now that we've got strength in the PMI index and the manufacturing index, and it gets worse. I'm seeing inflation come back in manufacturing. So let's first look at the ISM index. So it's got two names, PMI/ISM. So you can see it's actually coming up to 50. Actually, it's not updated. It actually went down to 47. But the point is it's come up from the bottom. Now, here's where it gets scary. When you look at the sub-indices, the sub-indexes for the index I just showed you, the manufacturing PMI index, and this came out recently, I think it was a week or two ago. These indexes are getting bearish in terms of inflation. So I'm just going to focus on one so I could get my point through. And that's prices. If you look here, I'm going to highlight a few. You can see, I'll make it larger too, so you can't miss it. You can see that, so April's on the left side, so you can see that prices went up from 49.2 in March to 53.2. That is a really bad sign. And you can see the percentage point change was up +4. And it says direction increasing. So that's a really bad sign. It says rate of change from decreasing. So and the trend is 1 month. So this is only the first month that this happened. But the point is, we're reaching that stage where prices came down fast and now they're bumping along the bottom. And that's a bad sign. And like I said to you earlier, I think the second part of inflation is going to be very difficult because wages are sticky, and we're seeing indications now that the rate of change in inflation is slowing. So this is very different from what other people are saying on CNBC and Bloomberg and what Raoul Pal is saying on Real Vision. So just keep that in mind. And lastly, if I didn't get the hammer, if I didn't nail the hammer, hammer the nail enough, I should say. What the Fed likes to do is look at new types of inflation gauges, and they're focusing on trimmed PCE, trimmed CPI, and something called sticky consumer price index. And you can see it's pretty obvious that we topped out, but we're not going down rapidly. So this is the epitome of what I'm talking to you about, is that inflation is going to come down slower. So what does this mean? It means that the Fed is no way going to pivot, not even close. If you're lucky, they're going to raise and hold. That's it. There is no chance in hell that the Fed's going to lower rates or even think about lowering rates. One thing I want to end it at is I always like to look at contrary points of view. So now I'm going to end it by showing something that completely disagrees with me. I really like to look at this gauge. It's called True Inflation, trueinflation.com. And it's been coming down at almost a 45-degree angle. So according to this gauge, so right now it's showing 3.49% as of today. So it's coming down at like a 45-degree angle. It's not showing any evidence of bouncing along at the bottom or going back up. So this inflation gauge is disagreeing with my whole thesis and story. But like I said, you gotta hear contrary viewpoints from what you're thinking, and you have to test your thesis. So I want to show you this data point as an example of what I'm talking about in terms of testing your thesis. Well, I hope everyone enjoyed this vid, and if you enjoyed it, tell your friends and please like us. Take care and good luck. Bye-bye.